Boom! Europe is shaking again. Gas prices are rising, energy bills are exploding, and millions of households from London to Madrid and Warsaw are bracing for impact. What started as geopolitical tension has turned into a full-scale energy shock. Tonight, we break it all down. Why gas prices are surging across Europe, what's really happening in London right now, how Spain is trying to fight back, what European media are saying about a new full crisis, whether inflation is about to return harder than before, and finally, a shocking twist. Gold collapsed to $4,100. Stay with us, because this story affects everyone. Curious? Let's dive into the most important news from the world of finance and business. Hello everyone, Gregory here, and welcome to Grigory's Economics, your economic channel. I am Gregory and this is another episode of weekly series covering global economic news. Unfortunately, a lot is happening around the world right now, so we can't skip any of today's topics. To our loyal viewers, I kindly ask for your support with a thumbs up, as it really helps us a lot. So without further ado, let's get into it. Why gas prices are rising in Europe? Europe is once again facing an energy crisis, and this time it's different. Natural gas prices have surged dramatically in recent weeks, in some cases rising over 25% to 80% in just a month. The reason? A perfect storm. The Middle East conflict, disruptions in the Strait of Hormuz, where about 20% of global energy flows, and critical low gas storage levels in Europe after a harsh winter. According to HSBC, gas prices could remain 40% higher than expected through 2027. And here's the key issue. Even though gas is only part of Europe's energy mix, it still sets electricity prices. So when gas spikes, everything spikes. London and the UK, ground zero of the crisis. In London, the situation is already hitting households hard. British media, especially The Guardian, are warning. Energy bills could reach nearly $2,000 per year. Gas prices jumped around 30%. Petrol and diesel prices surged by up to 17%. At the same time, UK manufacturers are facing the biggest cost inflation since 1992. Businesses are passing costs on to consumers, and mortgage rates are rising again. London is not just a financial center anymore. It's becoming a front line of Europe's energy crisis. Across Europe, the tone in the media is clear. This is not temporary. Reuters warns that Europe still hasn't solved its structural dependency on gas-driven prices. The Guardian highlights surging inflation pressure and slowing growth. The Europe Central Bank has already raised inflation forecast to 2.6% or higher. Some economists are even using one word again: stagflation. That means rising prices, weak economic growth, and increasing pressure on households. What is happening in Spain? The exception? But not every country is reacting the same way. Spain has taken a different path. Through aggressive investment in renewable energy and special markets mechanism, Spain has managed to reduce the impact of gas prices on electricity costs. This approach, sometimes called the Iberian model, effectively limits how much gas prices influence power bills. In simple terms, while much of Europe is seeing rising energy costs, Spain is actively pushing them down. The question is, can the rest of Europe follow? Is high inflation coming back? Now to the big question. Are we heading into another inflation wave? The data suggests yes, potentially. ECB forecasts inflation rising above 2.6% and possibly even 4% plus. In extreme scenarios, UK inflation could exceed 5% in 2026. Goldman Sachs expects inflation to peak around 2.9% this year. And here's the dangerous loop. Energy prices rise, businesses increase prices, workers demand higher wages, inflation becomes persistent. This is exactly how the 2022 crisis escalated, and central banks are worried it could happen again. And now, covered by this huge turmoil, the shocking twist. Gold collapsed to $4,100. Now, something unexpected. Gold, usually a safe haven during crises, has started to fall. Recently, gold dropped to around 4,388 per ounce amid market volatility. But some analysts are warning, if interest rates stay high and inflation becomes controlled, gold could fall even further, potentially towards 4,000 or 3,999. Why? Because gold doesn't pay interest. Higher rates make bonds more attractive. Investors rotate out of gold into yield assets. Well, what Gregory says. What am I saying? What do I think? I think that this is not truth, because all interest rates create additional money, and additional money is increasing M3, a money supply, and money supply is increasing gold price. So one day anyway, that will pay off in future gold price skyrocketing. Well, what financial experts are saying? Global financial voices are divided. Some analysts warn this is a temporary correction. Others argue gold has entered a new bearish phase. Economists point out, if central banks keep rates high to fight inflation, gold could continue to lose appeal. I said that anyway, in the future, it will rise by this additional created due to high inflation and high interest rate money. At the same time, if the energy crisis worsens, gold could spike again just as fast. So we are looking at a paradox. Energy crisis pushes gold up. High interest rates push gold down. And right now, the second force is winning. Well, but they don't remember about rising M3, money supply. Money supply is the key. Europe stands at a crossroads. Energy prices are rising, inflation risks are returning, governments are scrambling for solutions, from London's rising bills to Spain's energy experiment to global market reaction in real time. This is not just a crisis, it's a test of Europe's economic resilience, and the story is far from over. If you found this episode valuable, give it a thumbs up and subscribe to the channel so you don't miss future content that is posted here regularly. I also recommend checking out other interesting videos you will see on your screen, placed next to this one along with the subscribe button. Greetings to everyone on this beautiful sunny day, and see you next time. And here's something to lift your mood: a cat's reaction to the upcoming rise in cat food prices.